Hi everybody, welcome to another update on the stock screener. I stumbled on something interesting, and that's the liability management page of Saskatchewan. And when you look at this, the LLR program, it says that it manages the financial risk to the orphan fund, and it is designed to prevent orphaned wells and facilities. So when you go there, you can actually look at the reports, and yeah, this is the LLR summary. So I opened that, and it gives us a list of companies with the security adjusted LLR, and that's actually the assets plus the security balance divided by the liability. So the higher this is, the more assets they have compared to the liability. So a high number is the best. A low number, then you have a risk that they will have orphaned wells, and there could be financial risk. So I thought this was a very nice Excel file to look at. So what I did is I sorted it on LLR basis. So the best companies are on top, and the worst companies are at the bottom with the most risk. So I took a look at some of them. Vital Energy, for example, is supposed to be the best one. So I did a valuation on it, and I saw that the valuation is actually not that good. So based on current production, free cash flow is pretty low. They say that they will increase production, but it's not happening. So here you can see, for example, production went up, okay, but in 2022 it started to decline again. So something is wrong with this company. You can also see here, this is the equity. It started to rise, but it is flattening now. So I think they drilled some bad wells, and net earnings are almost zero. So there is some risk with this company. It was doing well, but lately they were not drilling the right wells. So this is a development company. They say that they will increase production. You can follow it, but yeah, they had some bad wells. We'll drill 5 more wells. So this one is out. Then we have Cenovus Energy. We all know them. These are the favorites of Eric Nuttall. Cenovus, Search, favorite of Shubham. Enerplus, favorite of Eric Nuttall. Gear Energy, a lot of people like that. Whitecap. This is the favorite of Peter Schiff. Crescent Point Energy. Journey Energy, I would avoid. They have a lot of shorts, almost 10% shorts. Cardinal Energy is very good, but they have a lot of they don't have a lot of production growth, a lot of capex, I think, 100 million, and not a lot of mine life. Also, not a lot of upside potential. So, yeah, I would actually avoid this as well. Baytex, probably one of the best. Then we have our peer day. I'm not talking about that anymore today. Paramount Resources, pretty stable, but it's not growing a lot. So there's not a lot of upside. Freehold Royalties, I have heard about this, the only oil and gas royalty company, but why would you just buy this? You could just buy oil. So we need leverage. So then we do not buy the royalties. Saturn Oil and Gas, I heard someone that wanted to have a valuation on that, so I actually created one valuation chart. It's called Soil. Soil, where is it? Here. So Saturn Oil and Gas is actually a pretty good company. Currently, at today's production levels, it's fair value, but they are going to increase production by 30% next year or this year. So the valuation goes from here to here. That's a double. So I expect a double for this year if they can get production up. Only problem is the dilution risk. They have quite a lot of debt, 440 million debt and 300 million market cap. So it's higher than the market cap, but I think it's manageable. It's 96% oil. Problem is they also acquire a lot of companies, so they like to dilute shareholders. There's also some warrants coming in at $3, so it's very difficult to get over the $3. Bad hedges, very bad hedges, because the hedged oil price is around 70 to 75, even to 65 for the coming years. So those are very bad hedges. If oil goes up, you have less upside. And high debt, of course. So yeah, it is a growth company, but bad hedges and dilution risk. So I would avoid this as well. Tourmaline oil, we know. Vermilion, that's more EU gas related, has also US oil, but a lot of revenue comes from EU. And the EU gas price is crashing right now. It's at almost 70 euros per megawatt hour, and everyone thought that it would go to 180. And there's a price cap on 180 euros per megawatt hour. So not sure what the EU energy prices are going to do, but this will hit Vermilion Energy. Pipestone Energy, I would avoid as well. Too much capex, less growth, and the stock has gone down because of that. Also, Pipestone has the highest decline rates of all the oil companies, so something to avoid. Rock Resources is pretty okay. I actually like Rock Resources. Plenty of growth in the future. Currently fair value, but next year production should go up. So there's upsides on this company. And they have hedges at $90 oil, so that's very good. They have done very well. Then EOG, they had, yeah, the wells were declining. The decline rates on EOG were steepening, so not the best company. Novista, I don't know. Pinecliff, yeah, I don't like Pinecliff actually because their reserves are pretty low. Pinecliff 6 to 8 mine life, that's not a lot. At 4 ICO, it's actually overvalued. So I wouldn't buy this one. Also no growth. So it also is at the bottom of this chart. Prairie Provident Resources, probably one of the worst companies with super high debt. Spartan Delta, I haven't looked at it, but it looks like it's going up a lot. Southern Energy I would avoid as well. It's at the bottom of the chart. They have a lot of capex. Not sure if they can drill the wells. Tamarack Valley looks actually a good company. This one is one of the largest companies, but I don't think there's upside. Bonterra Energy is one to avoid. This one is very bad. Prospera Energy, I have bought Prospera Energy. And I'm surprised that it is at the bottom of the whole chart. So yeah, that is a bit of a concern. But let's see. I think Prospera Energy needs to show evidence that they are able to do what they say, which is increase production like this exponentially. Currently at 1000 BOE. Let's see if they can get it to 2000 and to 3000 this year. So everything depends on those wells that they drill. And if they can do that and do what they say here, then there is upside. Upside at $80 is at least a double for this year, if they can prove those wells, because currently it's at the bottom end of this Excel. So they have a lot of liabilities compared to the assets. But as they drill more, then I think the assets will go up and will improve the numbers. So it's a speculation, I know, but we will see what happens. If you want to be safe, buy these ones, except the first one. These will all do very well. Just a little intermezzo, and I'll see you in the next video. Bye.